Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending your time with us. I guess we can finally say that everybody has now entered into summer mode or vacation mode. The kids that I guess that were in the public schools are now done school. They finished at the end of June, and now everybody is enjoying their vacation time and their summertime. However, as we know, the stock market never takes a vacation and it's never off for the summer. And interesting enough, waking up this morning, we saw the latest news out of the Middle East with respect to Iran, U.S. The U.S. saying that the ceasefire or the truce between them and Iran was now called off. We heard about some strikes overnight between the U.S. and Iran from both sides, and obviously the market is reacting today. So a lot is going on, even in these during these summer months when everybody is I guess away at their cottages or away from school. So what better time to have a show and to discuss what many individuals are thinking about with respect to their investments. So let's put up what our topics are for today. We have, is Canada on track with pipelines and critical minerals? Heather Exner-Pirot interview. A fantastic interview. Heather Exner-Pirot, she's a senior fellow and director of natural resources, energy, and environment at the Macdonald-Laurier Institute. She's also a special advisor to the Business Council of Canada. She is going to talk to us, or she did talk to us. I was fortunate enough to catch up with her this past week. We talked about Canada being a powerhouse in critical minerals and energy, oil production. We know we have a lot of oil. I think Heather mentioned, I think we're the fourth largest producer in the world. We know that we could be a powerhouse in critical elements or critical minerals. So we talked a bit about this and how Canada can compete worldwide with the likes of China on the critical minerals side. We can supply the rest of the world. We know the rest of the world gets 20% of their oil from the Strait of Hormuz or from the Arab countries through the Strait of Hormuz, and we know how volatile that is. Why can't Canada be the main supplier or a main supplier to replace some of that oil that is coming through the Strait and is so volatile? So we're going to talk a lot about oil, minerals with Heather. We have that interview coming up right off the top of the show. Top 3 things to consider over the next 5 to 10 business days, a very popular segment of our show. These are basically 3 things I think individual investors need to be focusing on before you create your portfolio and choose your investments. Markets and interest rates, what to expect in the second half of 2026. First half has been a pretty good first half. At times we were setting records, then we saw some pullbacks, and then only to see the market surge forward once again. So volatility, definitely, I think we're going to see in the second half, but we'll get into that with some predictions and a look ahead to the second half of the year. U.S. doesn't renew CUSMA. We've already heard that the U.S. is not going to renew the trade deal between Canada, Mexico, and the United States. The United States has chosen to opt out. What does that mean? Is it market moving? Well, so far, not really. What does that mean for us here in Canada? What's happening to Canadian GDP? We actually saw some really strong numbers in the month of April. Was this a one-time thing? Can we see some follow-through for the month of May? We're going to talk about that as well. Quick hits, 3 things that I've seen in the news over the last couple of weeks I wanted to comment on. And definitely, last but definitely not least, your questions. Anyone has any questions during the course of the show with respect to the interview with Heather or anything that I mentioned after that, please put them in the chat, put your questions in the chat boxes, and we would be happy to pick up those questions and answer them at the end of the show. So without further ado, let's get on to our fantastic interview with Heather Exner-Pirot. I'd like to welcome Heather Exner-Pirot, a senior fellow and director of natural resources, energy, and environment at the Macdonald-Laurier Institute. She also is a special advisor to the Business Council of Canada, the managing editor of the Arctic Yearbook. Heather is an international recognized scholar and policy expert whose work focuses on natural resource development, energy security, critical minerals, Arctic governance, Indigenous economic participation, and Canadian competitiveness. Welcome to the show, Heather. Great to have you.
Great to be here.
Thank you so much. And, there's been a lot of talk, obviously, it's been now going on for quite some time with respect to critical minerals and oil and everything that our country has a lot of. But yet, unfortunately, we seem to be not able to get a lot of these things to support and to get it to the rest of the world. We know the rest of the world needs a lot of what we have to offer. And as we hear in your province in Alberta, and we also hear in Ontario with our Premier Ford talking about how we could be a powerhouse in critical minerals and oil, even more so on the oil side than we are today. So I thought it'd be great to have you on to shed some light on these topics. And I guess I talking about oil first. We'll talk about oil first, and we'll go to critical minerals a little bit later. Canada is considered a large oil producing nation, of course. However, living in Canada, we know the issues that our country faces right now that prevent us from being an even larger oil producer on the world stage. What are your thoughts on how Canada can become a larger global producer? How can we make this happen? Why is it so important to our country and Canadians that we actually make this happen?
Yeah, fantastic question. So people may know that actually Canadian oil production has grown pretty much every year for the last 13 years. And they say, well, why are you complaining? We're increasing production. A lot of that growth is based on the big capital expenditures that happened in the oil sands in the 2000s and the 2010s. And so that was the last commodity cycle. Oil prices were high. They were running at $100 or higher for several years, hit $147 in 2008. That helped, incent the case for more investment in oil. The world was scouring the globe looking for better places, and the oil sands kind of came to be at that time, that it became technically feasible to get that oil at an economically good price. And we invested well over 100 billion, probably closer to 200 billion into the oil sands. And we've been living off that. We've been dining off those investments made 15 years ago for these last 15 years. And so the reason is we continue to increase production is because those upfront capital costs were put in place. Now it takes less sustaining capital to incrementally grow. And as well, pipelines that were put in motion in the 2000s, the early 2010s, the TMX, the Line 3 from Enbridge, those took a lot longer than we planned, but finally they got up and running years late over cost and gave us room to grow. But we are coming to the end of that. And obviously, under Justin Trudeau, there were policies that made it more difficult. The Impact Assessment Act, the moratorium ban, and I would say, the most impactful, that proposed emissions cap, which would have actually seen it wasn't just a cap; it was a cut, and oil and gas production would have had to decline. So no one was going to invest in the Canadian oil and gas sector as long as you had this threat of the cap and the cut. Carney came out with the MOU last fall and said it's gone. And then since that time in November, you've seen a flurry of pipeline announcements. And, we expect to get one, very soon on the West Coast pipeline as well.
And so obviously, you mentioned the West Coast Pipeline getting that announcement could come as early as today, I believe, or in the next day or two, I guess. We hear about pipelines and obviously an issue getting our oil from Alberta to the coast. Either way, I guess. Obviously, much easier going to BC. But in your opinion, how close are we? You think this is going to be the big announcement coming out in the next? I guess could be within hours or perhaps the next day or so. Do you think this is going to be the one thing that pushes us over the edge so that we can actually get oil to where we need to so that it can get to the rest of the world?
Yeah. So, obviously, we are the world's fourth largest producer of oil, third largest producer, exporter. And the reason we don't always think of ourselves that way is because for most of our history, it went purely to the United States. And so we were not a global energy producer. We were a regional energy producer, even though the volumes are very large. The United States had a lot of control over the price and that kind of a thing. So, as what we've been advocating for strategically, kind of Team Canada approach is let's get that oil, those incredible reserves out to global markets where you get a better price and where you can foster some alliances. There's really nothing that can tie you to an ally as much as providing them with their energy security, a reliable, affordable source of energy. And you see the lineup of countries in Asia and including in Europe coming to Canada and saying, wow, we would really like to get more of your energy. And so what is the opportunity for Canada? First of all, we were competing with what we call shale oil in the United States in that last commodity cycle. And so just as the oil sands were coming online, attracted investment, so did the shale revolution happen. It was hydraulic fracturing, horizontal drilling, and unleashed a tremendous amount of cheap oil into the world. And that's why prices came down. It is very much anticipated that shale has peaked, is peaking. And the question is, will it plateau or will it decline? But very much no one expects that the United States is going to account for that same level of growth. And sometime in the next few years, it will start to decline, actually. And so that is an opportunity for Canada to come in and fill that space. Then you also have, obviously, the situation with the Strait of Hormuz. And this is always a geopolitically tense area, but now it's absolutely punctuated. And for many of our Asian allies, they get upwards of 90% of their oil from the Middle East, sometimes the Middle East and Russia, neither of which are great choices. And they really want to diversify. It's become very important for security to diversify. And obviously, Canada is top of the list. One of the other few countries that produces right into the Pacific basin. Most of the oil that we produce today go into the Atlantic basin, and you have to go through choke points and hot spots to get it to those Asian, huge consuming region, by the way, and the fastest growing region. So that is the opportunity for us to try to get it to the West Coast markets. But the market is there. And that's why before this West Coast pipeline even was announced, there was already 1.2 million barrels of new pipeline egress announced. So there was the South Bow Bridger pipeline, which is kind of a redux of the Keystone. Enbridge has said it's going to expand its big pipeline, its main line, by 400,000 barrels. And Trans Mountain was already full, by the way, in June 2026 because of this crisis, was already planning on expanding it by its own 300,000 barrels. So the market is there, the wheels were in motion, but getting that million barrel pipeline to the West Coast is really what's going to make us popular, I would say, with our Asian allies.
Yeah, for sure. And you mentioned a great point, and I was actually going to ask you about this. So you kind of took the question from me, but with everything that's going on in the Strait of Hormuz, right, relying on that narrow body of water to get roughly what 20% of the world's energy out of, with everything that goes on in the Middle East, the uncertainty for countries like China and Japan and in Europe. Here we are in Canada, one of the largest producers in the world, able to supply many parts of the world, a stable supply. Here we are in Canada. We could be a great ally for our energy and the energy that we produce. So you would think these countries would come calling on Prime Minister Carney's door and say, hey, how can we get more from you? Now, I know that the oil we produce is more heavy crude. Obviously, I don't know if that's an issue for some countries, for some refineries, but I guess the hope is that we can come, I guess, I don't want to say to the rescue, but we could come to the rescue for the rest of the world in supplying that more stable form of energy. I guess that is what Prime Minister Carney would hope for, I would imagine.
Well, I mean, I think he's been confronted with it, that when he did do his tour, of China, Japan, India, Australia last year, that is what our allies are asking us. Germany is looking for that oil and in particular the natural gas. So, and then you had his Davos speech where he said, we are an energy superpower. And for me, that's when I started to believe that he believed it, because I know that his international reputation is important to him. Canada's in a situation geopolitically where we're looking for allies. And our calling card is oil and natural gas. And, uranium, critical minerals as well, of course. But those are the biggest traded commodities. And so there is pressure and incredible opportunity, though, is the other side of this. And sometimes I would say responsibility. And so it's not that Canada, with our, you're producing 5, soon to be 6 million barrels a day, can displace Middle Eastern or take over the Strait of Hormuz. We're not going to, we don't want to. But consider if you're an Asian country, and again, you have that incredible dependence, to have a little bit more buffer, to have a little bit more optionality, diversity in your sources is valuable, such that I think some countries would pay a premium for it. And to your point, yes, not every country can accept heavy oil. You need a particular kind of refining capacity to do it. India, China, Singapore already have that capacity. Korea already has that capacity. They've been accepting heavy oil from the TMX pipeline. They've gone to know it. They like it. They want more. And the question now is, will they invest, in some more heavy refining capacity? Can we co-invest? Alberta, for example, has been talking to Japan about buying a coker that would allow them to upgrade that heavy oil, thinking that, they want to have that option for decades to come.
Before we turn to critical minerals, I thought I would ask you an opinion question. This is something that I get asked about all the time, especially from investors, right? With all the oil that exists in the world today, U.S. producing by far the largest producer in the world, not even close anymore, is Saudi Arabia, but OPEC producing more and more, right? Their quotas seem to be going higher. Now Iran with the deal, I guess the peace deal going through, perhaps that we're hearing, they're able to produce more. And if ever we could ever get, I guess, a stop of the war in Ukraine, perhaps even Russian oil comes back onto the world scene. So I'd like to ask you this: where do you think the price of oil should be? We see. Let's talk WTI. WTI today is in the high 60s, roughly where it was prior to the war starting or the conflict starting. But with knowing all the different sources of energy that exist in the world today, would you say that the price of oil is sooner to reach $50 a barrel or $80 a barrel? And then would that affect the producers here in our country?
Yeah, I think $80 a barrel. And I've been surprised. I think a lot of us have been surprised that the Strait of Hormuz closure, the biggest event you could think of on oil prices, has not resulted in higher prices. And then you can go through the reasons of it: inventories depleting, the Chinese stopping importing, those kinds of things. But you'll be hard pressed to convince me that this kind of disruption won't have a long-term effect. And you saw it with COVID, you saw it with Russia. Sometimes there's a lag, but there is just no way that you can deplete, 500 million barrels of oil out of inventories. And still the strait, although not closed, is still not operating, certainly far from it at what it was operating before the war, to your point, when oil was again in the 60s and the high 60s. This at some point, these two things cannot coexist, that it will have to become apparent. You're already seeing it. There's evidence of this in the refining. The crack spread, the amount of money the refiners are getting is still very high. And at some point, I think countries will want to refill their inventories. In fact, I expect some countries want to expand their inventories, anticipating a disruption like this again. But also, people don't appreciate, a lot of companies sell forward contracts, and they did hedge, and they sold as much. When we thought that oil was going to be $80 in November, they sold as much of that $80 November oil as they possibly could, as people would buy from. And so they will get a higher price, throughout the year, certainly than what they're expecting in January. So all those things are bullish for Canadian oil and gas producers. But again, for me, it is the medium and long-term political consequences that is particularly bullish for Canada, that there will be, in particular, Asian off-takers that want to secure Canadian product, that want to lock in, and want to make sure that they're able to, get our pieces. And I expect that's part of what that West Coast oil pipeline will do, is probably attract some Asian equity stakeholders, off-takers, those kinds of things, because energy security does have a premium these days.
Yeah, for sure. And I guess, to me, it's all about supply demand, and we'll have to see how that all shakes out. I agree. I think a lot of these countries are going to build up their reserves again that they have depleted over the last few months. Turning now to critical minerals, and Canada's often been discussed as a potential critical mineral superpower, right? We hear Premier Ford talking about it with the Ring of Fire, etc. But getting a mine built can take more than a decade to build out due to the regulatory red tape and all that. Is Canada able to act on its critical minerals fast enough, or are we risking losing our competitive edge to other countries that can do this faster? Now, we know critical minerals aren't in every country, but those that, obviously China is the biggest. But are we just too slow to the game? And do we need to do things to get things done a little bit quicker?
So absolutely, we need to go a bit faster. And the reason for this is because mining is so upfront capital intensive. And when capital is coming at a high price, we can get higher returns elsewhere. It just hasn't been that attractive. And so if you're talking about a 10 or a 14-year build time, that's in capital costs and interest costs, that's tremendous. And so we are a more expensive jurisdiction. That's just a given. And so the question is, can we offset that expensiveness in our regulatory process, in our high environmental standards, in our labor costs, with, the rule of law and predictability, and some things, that make us more attractive than our jurisdictions. And I will say, we obviously were going the wrong way, kind of for the, 2015 to 2023. kind of thereabouts, that things were just getting harder. We didn't focus on rail infrastructure or port infrastructure. We made it very difficult to build that out as well, which, when so much of our product is landlocked, is very difficult. And obviously we had, unresolved issues with Indigenous rights. What were the expectations on the duty to consult and accommodate? What did UNDRIP, have to do with consent and moving forward there? And it's just difficult and uncertain. And so there, the sector was very much starved of capital. But I will say, with some exceptions, because I think this is important, gold actually did pretty well in Canada the last 10 years. And we did expand. And I think we built 6 gold mines. The last 6 mines that we built were gold until that McIlvaine copper mine came online about a month ago. Potash obviously was doing well. Uranium still doing okay. And so it wasn't across the board that we were uncompetitive, but in general competitive. And some of it was also the commodities price, and some of it was Chinese manipulation. So to the point, I have seen in the last year since Trump was elected, many of the provinces, Ontario included, have made changes to streamline their regulatory processes, give more certainty to investors. I think that's starting to bear fruit. The commodity cycle is obviously moving into an upswing, and so prices are justifying perhaps some new investment. And then there's obviously a lot of statecraft going on that governments, including Canada's governments, are willing to put to de-risk projects, to put in some money, to get off takers in Europe, and talk about those things in a different way. But the low-hanging fruit is still certainly our brownfield. Yes, it's going to take longer to build a greenfield, but Canada's not restricted to greenfield. There's so much brownfield or expansions of existing mines or restarting old mines that don't have to go through that 15-year process, that we could turn on the taps a lot faster to accommodate, what we expect are going to be those higher prices in the next 5 years.
Yeah, that'd be great. Those existing mines. Thought we'd end our interview today with a question about government. And as I'm sure you know, the government is moving toward critical minerals as they're treating it like a matter of national defense, which makes sense because critical minerals are so important to so many things that we do. If Ottawa's subsidizing specific mines and not others, do you think that helps Canadian mining companies compete globally? Or is this an example of government just meddling or interfering with the free markets? Should our government be putting money into this area? Perhaps, you hear the US government taking part ownership in a number of these companies. Is that the way to go? Do you think our government should do the same?
Philosophically, I don't like it. I do not like the government meddling. I think the government should set the rules and we could improve the rules. So number one job always, before you put in taxpayer dollars, make it an efficient regulatory process. Do the things that cost us zero money. But I have to say, I also follow national security issues closely. There are some commodities for which the market is not free, because in particular, China has manipulated, and we're not talking gold or copper, but things like graphite, lithium, rare earths. Obviously, people will be familiar with kind of what's happening in rare earths, cobalt, where there has been some manipulation, where there has been flooding, or there has been undermining of sectors as new mines come up from Western investors. So there are a few security sensitive minerals, which I think there is a justification for the government to intervene with. We were laissez-faire for the last 10 years, and China just took up more global market share, and now it's becoming a real security issue. But in general, I think, there's a number of tools governments can use. Equity is my least favorite tool. Okay, you can keep it in the toolbox, but let's try some other tools before we get there. Again, faster permitting and regulatory. I would say, contracts for difference on a price floor that works with the market, does not supersede the market, does not undermine the market. There are ways to set it up where you are interfering unjustifiably. And again, just increasing, trade deals with countries that may want to be that off taker. So there's lots of things we can do before we get to equity in mines, which I do not like. And even with graphite, which is where the majority of Canadian critical minerals money has gone into. I concede the value of graphite. China has a big monopoly on it. NATO considers a very strategic mineral. But I can't help but notice that it's also Quebec mines in Quebec ridings that are getting this money. And you see that it becomes a very gray zone.
Yeah, for sure. And as you can imagine, someone who is all about the markets and In the free markets, I agree with you 100%. I think we let the markets do what they do, and government can help getting things done faster, more efficiently, but definitely let the markets do what they do. Heather Exner-Pirot, a senior fellow and director of the Natural Resources, Energy, and Environment at the Macdonald-Laurier Institute. Thank you so much for being on our show. Love to have you back at some point to tell us what's new and upcoming. But thank you for shedding so much information, providing so much information on these topics of critical minerals and energy. Thank you so much for being on our show.
Yeah, great to be here. Thanks for having me.
Thank you. A great interview with Heather, talking to us about all things to do with critical minerals and oil and how Canada, our country, can become a superpower with respect to both those things. So thank you, Heather. It was very enlightening and information-packed interview. Now we're going to turn to the top 3 things that individual investors should be focusing on before you make your investment decisions. As you can see, our top 3 things for this show. U.S. big bank and tech earnings. The U.S. big banks will begin to report earnings beginning of next week and into mid next week. Always very important. JP Morgan usually kicks off the big bank earnings season. And obviously, we know big banks, or banks in general, are the bloodline of all economies for any country. So what they say definitely carries a lot of weight and should be looked at. Key economic indicators. We have a jobs number coming out this Friday. Canadian jobs will come out this Friday. We already heard from the U.S. last Thursday. They reported jobs for the month of June. We're going to get jobs in Canada and big inflation data, key inflation data coming out next week. And we're going to get CPI and PPI, Consumer Price Index, and wholesale prices the day after. Very important and definitely a market-moving piece of data. And the third point that I wanted to focus on for our show today, artificial intelligence and producers recently outperforming hyperscalers in the stock market. So basically, what does this mean? Well, it means that those companies that are producing the AI are actually outperforming those companies that are using the AI. And we'll explain that a little bit further. So let's move on to our first point that I wanted to focus on, which are the big bank earnings in the US. They're going to be coming out next week. We're going to get big bank earnings from JP Morgan Chase and Bank of America, the top 2 largest banks in the United States, Goldman Sachs, Wells Fargo, Citigroup, all of them reporting on Tuesday, July 14, and Wednesday, the 15th, we're going to get Morgan Stanley and PNC Financial Services reporting on that day. So we're going to be a lot of bank earnings coming out. We also are going to get some big tech earnings as well. We're going to get Taiwan Semiconductor, the largest chip producer in the world. You get the Netflix and the Apples of the world, looking to Taiwan Semiconductor to create the chips for these 2 companies. We're also going to hear from Netflix, a name that we don't talk much about ever since their bid for Warner Brothers unfortunately didn't go through. Paramount came in and scooped up the company. What about Netflix now? What are they going to do? What is their next step? They're about to spend a lot of money purchasing Warner Brothers and all the shows and movies and everything in their repertoire that they were going to buy. Now, obviously, that has not gone through. What is Netflix going to say? What are they telling us? How are earnings going? Are they increasing pricing? So a big report from Netflix, and that will come out Thursday, July 16th. So let's move to the big banks. What am I expecting from the big banks? And we can actually show our first chart, U.S. Financials ETF. There you have it. The big banks really have done phenomenally well ever since, I guess, in and around, let's say, May. They had a bit of a flat May, and into June, really moved higher in the month of June. And to me, that coming into this earnings season is a bit of a negative, right? You're seeing companies or banks like JP Morgan, our first big bank chart here, coming in close to 52-week or even all-time highs. You can see how high the stock has spiked, but we're seeing that really right across the board with U.S. big banks, very similar to what we've seen over the last year or so with Canadian big banks as well. Can you buy these banks into earnings season? A lot of their stocks or a lot of their stock prices have run significantly heading into earnings season. Our next chart show another big bank, Bank of America. You're going to see the same thing. There you have it. Look at that stock chart. A fantastic move higher in the month of June that we just came out of. I'm expecting some positive numbers. I'm expecting better numbers from JP Morgan. They actually had a bit of a soft quarter last quarter. I'm also expecting some bank dividend increases and some buyback announcements. So that's usually a positive for these banks. But make no mistake about it, names like Wells Fargo and Citibank, I think they're going to come in with really good earnings. They're going to see good numbers from equity trading, from banking, from wealth management. These banks make a lot of money when they're involved in certain deals, like we saw with Goldman Sachs, Morgan Stanley, bringing companies public, issuing debt or helping companies issue debt into the marketplace. And we've seen a lot of debt issuance from especially some of the big cap technology names like Amazon, for example, today announced, or yesterday, I believe, announced another big bond issuing. So a lot of these big banks are involved in that and obviously make a lot of money from it. So I think their earnings and their numbers will look good. But the question is, will they be good enough to take these stock prices to the next level? We've seen a lot of these pricing, a lot of the pricing on these big banks move higher before earnings are coming out. And that always makes me a little bit nervous because it sets the bar really high. And we know when these are high bars to pass, even though earnings can be good, like we saw, for example, totally unrelated in the tech space, we saw Samsung report fantastic earnings a couple of days ago, but they were really, really good, but the bar was set really, really high, and the stock ended up selling off. So we'll have to see what these big banks say, but a bit of caution heading into these reports. Next chart that we have, Taiwan Semiconductor. As I said, another great chart from a fantastic company. As we know, names like NVIDIA, they design the chips, create the chips, and Taiwan Semi actually makes the chips, headquartered still overseas and in Taiwan, of course. They have a lot of building going on in Arizona in the United States, a lot of plants that they're building there now to be able to produce chips in the United States. And that is, we're seeing more and more coming online with their locations in the US. So let's hear what Taiwan Semi has to say. I'm anticipating good numbers. Taiwan Semi actually gives us monthly updates. And over the last little while, their monthly updates have been pretty solid. So expecting good earnings. Again, the question is, with a chart like that and the stock trading near highs, can these earnings be good enough? Our last chart that we have for, I guess, the upcoming start of the earnings season is Netflix, as I mentioned. And you're going to see now the reverse of Taiwan Semi. Netflix has been going down since they were not able to purchase or acquire Warner Brothers. And ever since then, really, Netflix has been moving to the downside. Once upon a time, this stock traded well over $100 at the high, somewhere around 130 as a 52-week high. Today, trading in the high 70s. That's a stock that I've actually started to look at because it is so cheap, trading at forward earnings multiples of around 21 times, something that we have not seen from a name like Netflix in a while. So first thing I wanted to talk about as something that individual investors should be focusing on are corporate earnings season. And as I said, the big banks, followed by a couple of big tech names, I think they're going to be important for individual investors to be focusing on or watching before you make your investment decisions. Our second topic, key economic indicators. And I want to focus on a few things. Some of them are market moving, some of them are not so market moving. The first one, as I mentioned, Canadian jobs for June is going to come out this Friday. Definitely important for all of us here living in Canada. Is it market moving? Well, not really. US jobs is a lot more market moving than Canadian jobs, but Canadian jobs will affect things such as our Canadian dollar, interest rates, what is going on with respect to jobs. So it's going to be important for those types of things. As we know, interest rates are important for things such as real estate. And, our dollar is important for trade. And, when you want to take those vacations over the border to Buffalo and purchase some items, Obviously, our dollar is definitely doesn't go as far as it used to. Recently, we've seen our dollar fall towards the 70-cent mark. Early next week, we're going to get CPI from the United States and PPI the following day, Tuesday and Wednesday. This is definitely market moving. We want to know where inflation sits in the United States. We know it's been creeping a lot higher recently. Is it going to go even higher, or will we see a bit of a pullback in the rate of increase because maybe the price of oil, because it's come down recently, although higher today, perhaps that has affected things. We also want to know, is the higher oil price that we saw over the last couple of months, did that affect the core reading of CPI? We know that the headline number has moved higher, but the core has not moved as high. Even in Canada, core reading on CPI is around 2%. So that's something we want to see. We're going to keep an eye on. And last but not least, on Wednesday, we're also going to get a Bank of Canada rate decision. Don't expect any change there. But again, it's always interesting to hear what the Bank of Canada has to say. So a lot going on next week. Key economic data, commentary is going to possibly move markets. And if it doesn't move markets, it's definitely going to move interest rates and our currency here in our country. Our first chart, Canadian Consumer Price Index, wanted to show this to show that the median, or roughly the core rate in our country for inflation, is somewhere around 2%, which is target, which is actually at target. Yes, the headline number, which factors in energy, the core rate does not factor in energy. The headline number actually 3.2%, about 50% above the 2% that we want to see it at. So again, headline number due to energy or due to higher oil is causing a CPI headline to be higher than we want to, or we want to see it. Next chart here is Canadian employment change. As I said, we're going to get jobs data on Friday. Our last data for May was really, really strong. And can the data coming out Friday that will show us how June jobs fared, will that be as strong? We saw a bit of when the US reported jobs numbers, we saw a bit of a pullback from the May numbers for June. Will we see the same thing here in our country? We'll have to see in the morning on Friday. Next chart, U.S. Consumer Price Index, going to come out on Tuesday. You can see headline numbers 4.2%, and even the core reading is 2.9%. Once again, core just means it does not count or factor in volatile food and energy prices. Next chart that we have, U.S. PPI, wholesale prices. That's going to come out on Wednesday. You can see here, numbers are extremely higher than they were just, I guess, if you're looking at 2025 and, even 2023, the start of 2023, that we saw PPI numbers coming down. It's been on a steady incline to 6.5% ever since. And I'm sure that's something that the Federal Reserve is keeping an eye on. Our last chart here for this part of the segment, which is the Bank of Canada policy, an interest rate setting. You can see here that Bank of Canada, they have their meeting next Wednesday. They've been on hold pretty much for the last, 6 meetings or so. And I fully anticipate they will be on hold for a 7th meeting coming up on Wednesday. So very important economic data. Some will be market moving, some will be dollar or currency moving and interest rate moving, but nonetheless, something that individual investors need to be focusing on. Third topic I want investors to be considering before you make your investment decisions. And this is this whole idea of companies that help produce AI versus companies that use the AI. And for the longest time, we heard about how the Mag 7, the Microsofts, the Metas, the Amazons, the Googles, the Teslas, all these companies that were using AI, they were just going to the moon, right? Their stock prices were going up, up, and up. The one company was part of the Mag 7 that was supplying the AI or helping create the AI for these companies is NVIDIA, and they were just off to the races. And what's happened over the last, let's say, maybe 10 months to 10 to 12 months is we've seen a definite change. We've seen those companies that were using AI kind of fall back a little bit because there were concerns about how much these companies were spending. Was the return on investment good enough or equal to or surpass what these companies are saying they're going to spend this year, next year, years to come? Well over $1 trillion for these big cap hyperscalers, as we call them, or big cap tech names. And, what's their ROI, return on investment? So that's been a bit of a fear. So the market has started to change a bit, and they started to look to companies that are producing the AI, what we call the picks and shovels of the industry. And I use the analogy of the picks and shovels. Many, many years ago, those in search of gold went out west, the gold rush, and they wanted to find gold and fortune. Most of them never found the gold, but those companies that didn't care, they're the ones who they made money because they sold the picks and shovels to all those individuals and those companies that were in search of gold. So whether they found the gold was irrelevant. They didn't care. As long as people were searching for gold, they made their money because they sold the picks and shovels. So who's making money over the last little while? The picks and shovel type companies, the chip makers, the semiconductors, the chip equipment makers, storage, memory. Doesn't matter who's using these chips. The more companies that use the chips in general, the more money these companies make. Our first chart clearly shows the difference between those using AI and those that are supplying AI. ETF tracking MAG 7 underperforming on a relative year-to-date basis. There you have the SOX. Those are your semiconductors. Those are your chip makers, the AMDs of the world, the SK Hynix out in South Korea, Samsung, Micron, and then also some of the storage guys. You have the Western Digitals, the SanDisks of the world. These are the companies that have been outperforming. You look at the NASDAQ 100, which is the index, and you look at the MAG 7. Look at the MAG 7. Has basically done nothing coming into this July. NVIDIA, the king, right? The biggest company in the world, really, their stock is down from the highs that we saw about a year ago. So if you want to compare MAG 7 to the semis, you can see how big of a discrepancy there is. Some of the companies that I wanted to focus on are a chart here of Amazon. You could see how Amazon, yes, it's come up recently because what we've seen actually in the last, let's call it, couple of weeks, we've now started to question, investors questioning just how high these chip makers can go. How high can the storage companies go? How high can the chip equipment makers go? So we're now starting to question the makers of AI. Not that their price of their stocks are cheap. In fact, on a PE basis, their stocks are actually relatively cheap. But how high can these stocks go? How much more can they sell to these hyperscalers or big cap tech names? So we've seen a bit of a sell-off in Micron. We've seen a pretty big sell-off in Western Digital. And now people are starting to buy names like Amazon once again, names like Meta once again, Microsoft, even though it's considered a software company to some degree. They're even buying some Microsoft. So that's why you're seeing the sell-off in Amazon on this chart. But on the far right-hand side, Amazon is starting to move higher once again. Next chart that we have, Meta Platforms. Meta, a name that I've been talking about now for quite some time. You see the big sell-off, and as we moved into July, a bit of an uptake. Stock now trading over $600 a share, down a little bit today based on the announcements out of the Middle East, but nonetheless, stock been doing quite well. Microsoft, next chart, you'll see the same thing. Underperformer versus the chip makers, the semiconductors. But again, on the far right-hand side, starting to move higher. Is this the time to buy Microsoft? Well, I think for those individual investors that can handle the volatility a name like Microsoft brings, I would say yes. It's a name I think you should look at this time. Next chart, semiconductors, just an ETF of the semiconductors. There you have it. Look at that chart and look at a bit of a sell-off at the on the far right-hand side, starting to come down a little bit. Will we see another surge ahead? I think some of these semiconductors have become a lot cheaper in the last week or two. A lot of them are down 20, 25% or even more, but they had surged 500%, 1,000% in the case of SanDisk. So keeping it real, or relatively speaking, the downturn is nowhere near how much these stocks have climbed. Next chart is one of Micron. Micron shows, you can see the Micron chart. Yes, a bit of a downward chart on the far right-hand side, but look at the increase, nowhere near how much the stock has gone up. Micron, memory chips, high band memory chips is what they supply and why they're doing so well. Advanced micro devices, our next chart, AMD in competition with the likes of NVIDIA. They do a fantastic job. I've seen some target prices of over $600 a share for AMD, and it has done well. Western Digital. If you look at Western Digital, our next chart, you'll see a tremendous increase followed by a tremendous decrease. I mentioned that just a minute ago, and a name that, again, has come down quite substantially since it reached their highs, I guess, somewhere around mid-June. And SanDisk, probably the biggest increase was in SanDisk shares. These are all storage companies, memory companies, chip companies in general. And you can see SanDisk has come down quite a bit as well. So I think when you're choosing and you're building out your portfolio, you want to make that distinction between the companies that produce the AI or help produce the AI, companies that use the AI, and make no mistake about it, names like Amazon and Google now, they actually produce and use the AI. They're producing their own chips now. So we have to be mindful of these companies. We have to be mindful of how these companies have run significantly higher already. Are they now on sale because they've fallen back? What we need to do while we're creating these portfolios is analyze the situation, understand what these companies are doing. That combined with the economic data and big bank earnings that are kicking off the earnings season. All three of those things, in my opinion, is what individual investors need to be focusing on before you make your investment decisions. Markets and interest rates. Where are things going in the second half of 2026? Well, first half of 2026, the markets did fantastic. But I think there's again, individual investors have to take a step back. A lot of people, especially those that have invested in tech, made a lot of money in the first half of the year. But overall, the S&P 500 coming into today was up in and around 9%, 9.5%. Market's down a little before we came on air. So let's say S&P 500 is up about 8.5%, 9% for the year. A fantastic number, on pace to do what? Maybe 16, 17%, a few percent even higher than last year, which was about 15%. But we saw in 2024 and 23, S&P 500 made over 20%. So again, for those that have made a lot more than 8, 9% at this point in the year, that's going to be because you invested in a lot of technology. So we have to keep things into perspective. What's going to happen the second half of the year? Well, volatility definitely is going to be with us. I anticipate a lot more volatility to continue. We're also coming into shortly the period of August and September that we see a bit of a pullback historically in the markets. I think we could see another one again. I think we also are used to seeing a 5 to 10% decline at least twice a year. We saw one earlier this year. I'm very well expecting we could see another one, another 5 to 10% decline, perhaps August and September. Maybe it'll come around when the elections, the midterms happen in November. Not sure. But I think if you're an investor and you've done extremely well, I think you got to be bracing for a bit of a pullback at some point. But I do expect the second half of 2026 to be positive, just not as positive as the first half. Our first chart, S&P 500 monthly returns. We can show it there. Why do I think we could see a pullback? Well, you can see here from 1928 to 2023, September has been in the red. And we've known this. We've talked about this on many shows before. Can history repeat itself? I think it can. We could see a bit of a sell-off at the end of the summer and into September. We tend to see it more often than not. Next chart shows the geopolitical factors. Politics affect the rates of return. And you can see average midterm election year. So that's what we're in right now. We have the midterms in the US, 4.7%. Other years, or all other years, 9.5%. So you can see that the midterms, definitely in years that we have midterms in the United States, we do see that markets or the markets in general tend to underperform all the other years. And as this next chart will show, which is the S&P 500 performance during the 4-year presidential cycle since 1932, year 3 of a presidential term is usually very, very good. So the second year is the one we struggle in. The third year is the one that we do well, or we see markets outperform. Changing gears a little bit, let's move over to interest rates. What do I think is going to happen with interest rates? Well, I think interest rates are going to come down, which is maybe a surprise to hear. Yes, I know today with what's going on in the Middle East and and interest rates started to rise because there's a talk that oil prices are rising because of the war picking back up again to a certain degree. Inflation might continue to stay high, etc. What does that mean for interest rates? Well, they'll have to move high if inflation is high. I'm still not a believer. I still think, in my opinion, we could see the Fed talking about an interest rate decrease by the end of the year. Our next chart is a 2-year Treasury from the United States. You can see this anticipates what the Federal Reserve will be doing. And you see by it moving higher, they're anticipating the Fed will move higher. We have a 5-year rate as well. US 5-year Treasury, again, affected by what the Fed says and what the anticipation is, and a 10-year rate. 10-year rate usually doesn't move much with respect to what the Fed says, but 10 years is important because that is what mortgage rates are based off of. Our last chart for this segment is one on WTI crude, and you can see how much crude has fallen, which is why I think the Federal Reserve may be able to look at reducing interest rates by the end of the year. But you can see on the far right-hand side that we started to see a move higher in the last few days. And again, that's on the belief that the ceasefire between US and Iran might be in jeopardy. So, overall, I think that, the markets and interest rates, I still believe we're going to see a positive second half of the year. I still believe we're going to see interest rates coming down in the US and coming down in Canada. I'm hopeful for Bank of Canada rate cut. I'm hopeful to see a US rate cut. I guess time will tell, and a lot will depend on what happens in the Middle East. U.S. doesn't renew CUSMA. CUSMA, as we all know, is the trade deal between Canada, the United States, and Mexico. For some, it's USMCA, which it would be the U.S. first. I guess depends on where you live, which country you put, which letter represents your country goes first. And U.S. recently said they're not going to agree to the deal, which means basically, in my opinion, not an awful lot. It just means that the deal doesn't get extended for the next 15 or 16 years. I forget the time period, but I think it's somewhere around there. And it means that instead, these countries have to negotiate on an annual basis. Okay, well, maybe that's not a bad thing. I know for Canada, the US is pushing for certain things for our markets to be opened further, our dairy, our telecom, our banking. The United States, meaning they want to see us open our markets so that their farmers, their dairy farmers, can sell more into our market. We know here in Canada, because our markets are closed in a number of areas, that the average consumer in Canada actually pays more money for dairy products. The average consumer in general pays more money for the products we buy, consume here in our country because of the the policies that our government puts in place. But on the flip side, obviously, those policies are crucial to keeping our farmers employed and with a job, because obviously if there's too much foreign competition, prices come down, good for the consumer, but not good for some of these businesses. However, when looking at CUSMA and the fact that it's not being renewed by the United States, I don't think it means an awful lot. And I wanted to show this with our first chart here. You can see U.S. trade in goods with Canada. It's a bit of a smaller chart, so I'll read you the numbers. The most important number, in my opinion, is total trade between January and May of this year, about 144,000, or I should say, this is in millions of dollars, I believe, 104 million. So the number is not that much different than if you scroll down to the bottom of the second chart, what it was in 2025, 143. So is CUSMA really, or the U.S. saying they don't want to renew CUSMA, is that a big deal? The numbers aren't really that much different. And when you look at the balance on the far right-hand side, yes, the U.S. is in a bit of a deficit with us, but overall, it's really not that much different. You're looking at imports versus exports. It doesn't look like much is happening with respect to a difference between what we thought was going to happen and what is actually happening. We have been able to continue to sell our product to the U.S., even with the tariffs being put on Obviously, Kuzma has helped. A lot of what we send to the US is tariff-free. And, renegotiating every year and talking about Kuzma every year. Could that change things? Yes. But if things stay status quo and we continue to negotiate, I don't think it's going to mean an awful lot for our trade between the two countries. It might mean specific negatives or positives in specific industries like steel and aluminum, etc. But overall, in general, I think that Canada continues to have a good trade relationship. But of course, the uncertainty that every year brings with the negotiations, will definitely affect business being done between our two countries. Our next chart, U.S. doesn't renew Kuzma, U.S. effective tariff rates by country. And this is actually my favorite chart for the show because it shows what Mexico and Canada, what our tariff rates are. You can see they are the lowest out of any of the other countries. But if Kuzma were to go away and if it were to stop, you could see Mexico and Canada, which is the yellow bar, how much the tariffs would affect business and percent of U.S. imports would be affected. And you can see our next chart here. We have U.S. Actually, it's Canadian manufacturing has high Canadian U.S. content. We know that the U.S., when they're importing things such as automobiles, we know that they want a larger component of U.S. content in things like light duty autos, heavy duty trucks. And you can see the yellow bar clearly shows that a lot of the things that we're sending down to the US does have a large US content. So begs the question, what more does the US want from Canada? Well, as I mentioned, they want to see more opening of our markets. And to me, that I'm not sure if that's going to happen. I know that the Prime Minister is holding firm. They're trying to make up the difference between what we're going to send to the United States that perhaps they're not taking anymore. We're trying to make it up with deals around the world, with other countries, with Europe, with countries in Asia. And so far, the Prime Minister has made a number of deals with respect to LNG, with respect to many other things. And we're obviously hoping that the difference can be made up with a lot of the deals that the Prime Minister has taken on and will take on in the coming years. So what's happening with Canadian GDP? Recently, we had some April numbers, and they were pretty good. 0.5% growth in the month of April, well above what we were expecting. Recently, as you know, we've been receiving negative GDP or negative growth, putting our country in what we call a technical recession. So when April numbers came out, they looked pretty darn good. Our first chart shows good producing industry led Canada's GDP growth in April. But the one thing I want to focus on is look at the oil number. Mining, oil and gas extraction, 0.21% of the 0.5, almost half of the growth came from the oil and energy industry. Will that be maintained? Back in April, remember, war was going on. A lot of number of things were going on, different than what we see today, although this morning it seems like the war may be back on again. But prior to that, we saw the price of oil dropping. We saw a lot of energy being produced by OPEC nations, increase in quotas. Will this affect oil? Will this affect GDP in Canada? I think it just might. And we could see a different number for the month of May. Our next chart shows this, what we're anticipating for the month of May, and the chart Canadian GDP growth rate by month. There you have it. We're only anticipating 0.1 growth rate for the month of May, that all the gains that we received or that we had for the month of April could evaporate depending on what happens with oil. Now, of course, we did see a surge in other services, 0.2%. So perhaps we're going to have to rely on that more so than oil and materials. So what's going on with Canadian GDP? I guess the quick way to answer that is not sure. We're seeing positive data, but can we rely on just 1 month? The answer is definitely not. We're going to have to see what the main numbers bring, and we're going to get that data coming up in the next couple of weeks. And I think that will go a long way to paint the picture as to how the second quarter has fared for growth here in our country. These are three things that individual investors, or at least that I've seen, I'm sure individual investors have seen the quick hits, some of these things as well, but these are three things that I've seen in the news over the last couple of weeks that I wanted to make a quick comment on. Some of them are quite interesting, such as our first one. Danielle Smith, Premier of Alberta, Doug Ford, Premier of Ontario, announced proposed cross-Canada oil pipeline corridor. This is reported by CTV News, a pipeline between Ontario and Alberta. I think that would be fantastic. Second quick hit, OPEC Plus approves further oil output increase as Hormuz exports start to recover. So OPEC is just not standing still. They want to continue the production and increase production. They keep increasing their quotas. And our third quick hit, why the memory chip boom is a problem. When things get higher and higher pricing, that tends to be a problem because the consumer, the person that is, or the company or the country consuming the product, tends to find alternatives. So let's go to our first quick hit. And I think this is a great picture. We have our first illustration, and it's the Northern Shield proposed route for the Northern Shield Energy Corridor. Look at that route. If we could get that route set up to have oil going from Hardisty, a place in Alberta, tough to pronounce, Hardisty, all the way to Sarnia, that would be an unbelievable thing. And it's great to hear that the two premiers are talking about it. So hopefully we can hear more in the coming days and months. Next quick hit that I stumbled across that I thought was interesting is the continuing increase in production from OPEC Plus nations. We have two charts showing WTI and Brent crude. There you are. Because of the oil production, the continued oil increase in production, we're seeing oil prices continuously coming down on the world stage, whether it's Brent crude, which is more in Europe, or WTI, which is the U.S. Measurement, or the U.S. WTI crude is more of a U.S. number, and Brent more European. Our last quick hit, why the memory chip boom is a problem. And like I said, anything can become a problem if prices get way too high. We're already starting to hear the likes of Apple asking the President of the United States if he would allow Apple to actually source memory chips from China. Yes, from China. We know China has been taken off the table, that the United States does not want the U.S. doing business with these companies, but the Apple is asking if there can be an exception because memory chips are just too darn expensive. Our first chart shows these memory chip companies and how well they are faring. As I said, these memory chip makers, we have SK Hynix at the top, we have Micron, there you have it in the green, and you have another company, Kioxia Holdings Incorporation, Samsung and Western Dig, all these companies, but no one really has done as well as SK Hynix. And coincidentally, SK Hynix, South Korean company, along with Samsung, will actually begin to trade on the New York Stock Exchange on Friday. So a company going public in the United States, company that has been public for many years over in South Korea. But you can see that high memory prices help these companies, but it will cause at some point companies to start to look or start to source from other areas. What's my take? Part of the show where I take at least one question from the audience. And today our show's been running a little late because of that fantastic interview from Heather. It's a little longer show today, so thought I'd squeeze in just one question here. And here's one. We have a few that we've been asked. Some of my friends are using AI as they plan for retirement, including getting more information on investments, etc., tax and budgeting. Can they trust information AI is giving them? So basically the question is, can you trust AI to do your budgeting, to do your tax planning, to do your taxes, to pick your investments? And I've had this question many times, obviously, over the last little while. And my answer is, I think the information at times can be a little misleading. Obviously, the information at times may not be 100% accurate, so you got to watch for that. But overall, I think you can use AI to do some of the things you want to use or to do. But I think at the end of the day, you need to be able to bounce off what you are doing with a professional. There's no doubt about that. I think you need to understand what's going on to be able to ask AI the appropriate questions to get the appropriate answers. But overall, I just don't see that if you go to AI, whether it's ChatGPT or Anthropic, and ask what's the best stock to buy today in the market, that they're going to give you the best answer. They'll probably give you the most popular answer, but I just don't think the most popular answer is always the best answer. So with that, I want to say thank you to everybody who tuned into our show. As always, I hope everybody took away some bit of information that they could take away when you invest your money. And of course, if you have any questions regarding the information you heard on our show today, please send me a message. Let me know how you think our show was today. Did you like our interview? Give us some feedback. We're always looking to change our show, improve the show, and who better to give us some feedback than those that watch the show. So I want to say that we will be back 2 weeks from today, 12 noon. That is Wednesday, July the 22nd, across all social media platforms. We will have on our show Pedro Antunes, chief economist at Signal 49 Research. He's going to be talking to us about the state of our economy, potentially including Canadian and competitiveness and trade. We're going to talk about all that, and promise to be another fantastic interview and fantastic show. So until then, I want to wish everybody happy investing.